Sunshine, lollipops, and rainbows. Everything that's wonderful is what I feel when we're together. Brighter than a lucky penny when you're near. The rain goes, disappears, dear.
Good afternoon. It is Friday, April 4th, 2025. This is MrNotAdvice and my weekend update for my Discord members, VIPs, and Fight Club. Heck of a week this week. Oh, before we go on, of course, the standard disclaimer, this is not advice. Nothing I say in here should be construed as advice or an offer to buy or sell any type of security or investment. Never get any advice, especially investment advice, from a complete stranger off the internet. Everything in this is my opinion only, and of course, I could be wrong, and often I am. So, first, let's start with this chart. So, as we were going into the Trump tariffs, in the very beginning, there was this market belief that we were going to get a similar price action to the last time Trump did his tariffs. That obviously is completely broken because this week, not only did the U.S. market go red, but we had global stocks go red. So one of the things that I am keeping an eye on, quite frankly, is there's a difference between soft data and hard data, right? And typically what you're going to see is that the soft data, which is leading right now, so soft data moving down, the challenge that the market's going to, or the bet right now is which is going to win, right? Is it going to be the inflationary data? Is it going to be the jobs data? Or is it going to be interest rates? So where this battle ends up, these gaps normally do close, but I think that's more of a reversion to the mean function than anything else. However, yesterday's comments from, or this morning's comments from Jay Powell, which were actually somewhat hawkish, because what he didn't do is he didn't say anything more dovish. I actually agreed with what Powell said this morning, that he's still waiting for the sum of the data. They don't know what's going to happen with tariffs, and so it's difficult for them to project what effect it would have on GDP. As a side note, by the way, as all of these mainstream media and stock gurus are losing their mind over today and yesterday and this week's action, that the reciprocal tariffs don't even go into effect till April 9th. And I want you to remember that date, by the way, of April 9th. So looking at, we had the S&P experience its largest two-day drop since back on March 11th. Now, when that happened, the Fed did a bailout. That's not coming this time. First of all, there's not an appetite to do any type of bailout, especially for financial institutions. And we are in a completely different environment than we were then. So, but just an idea in terms of, if we're looking at, from a contextual standpoint, this was a big deal drop this week. So now, having said that, I know my members, the majority of them should be at least 80, 90% in cash. So we have avoided all of this. Our frustration for the last 3 months has been finding a market that, having a market environment where we had trends were able to establish themselves and then continue. Looking at just some snap comments here, it was the worst week for world stocks since March 2020 COVID. This was the worst week for U.S. stocks. Both the NASDAQ and the Russell are in bear market territory, which is down 20% from their highs. And the Dow fell a record 2,200 points today. Today was the highest volume session in the history of the U.S. stock market. And the VIX saw its biggest weekly jump since February 2020. Crude prices crashed today. Gold prices, this was only the second week it was down this year, but I want to show you some. This is the chart you're looking at right now. A lot of people you'll hear talking about credit spreads, and once you start seeing high yield credit spreads, they'll use the term blowing out. Well, that's what's happening on this chart. So effectively what this is the cost of insurance to insure high yield debt instruments, and that's what's spiking. And it spikes because there's concern that high yield, the issuers of the high yield debt instruments um, might have a higher challenge in repaying their debt. So that insurance cost goes up. Is that a binary signal that the market is going to collapse further? No, it's not. But it is something to keep an eye on, because when you see a blowout on credit spreads, that's when you will start hearing the words of default and contagion and all of that. So we don't want to hear that. One thing that I did notice, looking at interest rates, they were obviously monkey hammered down this week, and I think the 10-year rate was able to finish above 4%. One thing that's super important, I shared with my members that one of the benefits of lower rates that a lot of people don't understand is as the U.S. Treasury continues to refinance its debt, for example, this week with the 0.67, I think, percent drop in the 10-year, that was a 300 billion, over a $300 billion savings in interest on the refinancing of this week's debt alone. That's massive. And if we can continue to do that, continue to take our shorter term debt and refinance it at longer term rates that are lower, and therefore we save on interest costs, that's also going to have a multiplying effect on the overall health of our economy, which is interesting because if you look at what happened with the US dollar this week, right here, the US dollar actually today got slammed down, but and yesterday, but it recovered today. And you may say, well, why would that happen? The stock market's going down, the bond market, people are fleeing to bonds. Well, I think two reasons. For all the criticism, the U.S. dollar is still um, the world's reserve currency. Much of the world is at some point throughout their supply chain or their sales cycle forced to trade in U.S. dollars. More importantly, it's what oil trades in. So looking at the U.S. dollar, I found that today's strength was probably primarily, in my opinion, was primarily due to the fact that we had some of the countries bend the knee. We also had worldwide currencies deflating. And if you've got a falling tide and all currencies are dropping because of devaluations, because of growth concerns, then it would make sense to me that the strongest, which is the US dollar, based upon its economy that it's based upon, um, would rally today. So I also think there was some flight to safety too because of the global markets um, being crushed. One of the things that gold was also monkey hammered down, but it did close positive for the week. I think today and we saw this yesterday and this move down here. I think today what we had was a case of throwing the baby out with the bathwater. I think all assets were being sold today. I think a lot of the selling today was mechanical, meaning that I think a lot of it is driven by hedge funds and CTAs and institutions that manage their accounts not only for profit loss, but in short-term timeframes, they're managing according to whatever Greek combination they have and what they're required on their hedging. So I think a lot of it was mechanical. That's not to say that there weren't institutions that were pushing the button to reduce risk. Certainly that was going on today too, as well as yesterday. One of the things, and this is oil, oil got absolutely slammed down. Why would it get slammed down? Well, because if there's a growing concern of a global recession, that would translate into a perceived drop in demand for petroleum. So it's completely understandable, but I think anybody going short oil needs their head examined because Trump has made it very clear that he intends to bomb Iran by September. So who knows if that'll happen or not. One of the things that I was taught very early on in my career was there's a canary in the coal mine when it comes to industrial slowdown within the U.S. and manufacturing slowdown, uh, and that's copper. And so when we see the price of copper drop, which it really dropped today, um, that to me is further evidence that the investment community is becoming more and more concerned that this could become a deeper recession. I've been of the opinion with my members that we've been in a rolling recession for the last 2 years. It's just gone through industries, but we're talking more of a broad-based recession here. And do I think we're headed to that? I don't know yet. Okay. We've got to see how these tariffs play out. As a side note, JP Morgan, after the market close, now prices in a 60% chance of a recession this year. But even that to me is, you got to understand something. When JP Morgan and Citi and these guys come out, remember how they make money. They make money in transactional volume. So there is somewhat of a feeding the storm that benefits them. Um, I don't think that it is that there's enough data at this point to say that we are headed to a recession. Also, as a comment, one of the things that you're seeing in the market today, and I encourage you not to do it, is what I call straight line extrapolation. So you take a day like yesterday and today, and typically what investors do, and human beings a lot do, unless they have emotional control and ability to have perspective, is they will take this and they will say, well, in their mind, well, I guess we're always going to have tariffs. This is the new paradigm, and the stock markets can continue to go down thousands of points of every day. And that's what's going on with the tariffs. For example, okay, so Goldman comes out and says that the weighted average tariff rate is 18.3%, right? And that's 3% higher than the bank expected. And that's why Goldman put out a negative note about the tariffs. However, when you look at the details, roughly a third of total imports across the board are exempt, which makes the actual increase in the effective rate 12.6%, which is below Goldman's 15% increase. So again, fun with numbers. Goldman has an objective. All the banks have an objective, and don't think for 1 minute that they don't love this volatility. I bet you today was one of the highest commission transaction days for these houses, probably in many years, maybe since COVID. So be careful and take it with a grain of salt. I guess if I could say anything, don't engage in straight line extrapolation. Don't sit there and take where you're at today. Allow your emotions. I mean, it's easy to get involved in all the hype and doom and gloom, but uh, it's important. I'm glad it's the weekend too, because people need to step back. We're not at the edge. Yes, we could go a little bit further down, but this is not the end of the world. And that's what effectively the mainstream media, CNBC, are saying right now. This is it. Uh, what did I just see? The end of American exceptionalism. I mean, really? I mean, the guy's been in office 100 days. So he's going to be blamed for the end of Americans' exceptionalism? I don't think so. Looking at even still with the sell-off today with the VIX up above 40, I mean, in COVID times, we had it above 50 for weeks. So I don't see, 2008, I don't see that this volatility spike right now is foretelling or indicating that we're ready for a huge another leg down. Like I said, we may go down test to 5,000 to 4,900, but I'll get to the charts in a second. SPX flow of funds. So one thing that anybody, if you're looking for, when will institutional buying, forced buying by CTAs and hedges on a seasonal basis come in? Well, it's April 7th. Okay. Tariffs, reciprocal tariffs go in place by April 9th, and I do expect some movement over the weekend, at least news on the tariffs. Looking at the charts, let's just go through them. The S&P, SPX this week, obviously major down day, but look at where we're right at the support level of 5,000. And I think I said earlier today, it was around 5,018. What was the low today? 5,069, right? So for around 5,000, even number, that's our support. We're in that supportive area. How low could it go? Well, we have a 52-week low at 49.53. From here down here, I do expect a bounce on Monday or Tuesday, and that's entirely driven by that this market is very oversold, and at some point, shorts will start covering. Okay, whether that's enough to, well, how high do I think that will go? Oh, I don't think that bounce would go much above 5250 to 5300 into this before this gap. So I am expecting on Monday or Tuesday a dead cat bounce. I also think that Sunday night's futures will, as always, will be interesting. But if we can get that break in the morning and then bounce, Um, I think that I expect the lows to be retested on Monday. Whether those are the overnight lows or today's lows, I expect the lows to be tested. Looking at the technology sector, the QQQs, we touched back on August the 2nd of 2024. We hit a low of 453. Oh, I'm sorry. We hit a low of 423.45, and today we hit a low. Whoops. We hit a low and we closed at 422.67. That's a proper test. How much lower could we go? About 400 to 411. So another, 2 to 5%. Again, I don't know if the bounce will happen Monday. I think it will happen late Monday or Tuesday. Looking at the individual stocks I'm in, I got smashed on WPM today, just throttled. So I'm going to have to look for a retrace uh, um, on this candle, which I expect on big red or big green candles the next day. I do expect a retrace. So we've got, I will be looking at, this was a half position, so I will look at adding back into my position. I've already scaled on it and rolled and bought myself time, but I'm not going to go unless I get a retrace up here Monday or Tuesday. I'm going to have to think very carefully about adding gold up here. Looking at Tesla, Tesla today, we are, as far as I'm concerned, still stuck inside this battle zone here, right? That we've been stuck in since about March 4th. So until we test this low at 214.95 or 214.05, I don't see Tesla. Quite frankly, I think it could get stuck in this range here between 200 and 290, let's call 300, where the 200-day moving average is. And again, we're not probably get a lot of clarity out of Tesla. Either Tesla's going to go up because the overall market is rebounding, or Tesla's going to go up closer to earnings announcements and then update this summer on FSD as well as Robotaxi. Looking at Groupon again today, also got monkey hammered on that, so I'll be getting stopped out on. Well, I'm looking for a retrace because I'm down to runners on this. I'll have to look. I think I'm still up 55 or 60%, so I'll look to close this on mine unless I get a retrace. Easy Pawn held up pretty well today. And in fact, if we look at Easy Pawn, I had a stop at yesterday's low of 1523. Let's see, 1525 was yesterday. We closed at 1523. And so Monday, if we don't get it back above that level, then I will also be looking to close. Let me actually raise my stop right now. We're not going to give it a lot of room. EOSE, and I'll get to the commentary about that podcast, the short report, in a second. EOSE bounced at an excellent level at 366, right? Not only did we bounce at 366, we came very close to touching the 200-day moving average. Now, I don't know if this test is done yet, so there might be a little bit more room now to the downside, but certainly this was a strong candle today. And remember, a lot of what's going on in these small caps is there's a rotation, and I said this months ago, there's going to be rotation out of small cap stocks that are pre-revenue or low revenue companies into more stable, more conservative investments. Those would be, industrials, tobacco, all that stuff. So some of this is also reallocation of portfolio managers. Looking at ENVX, actually ENVX today, from a technical basis, I made this comment to one of my members. From a technical basis, it is now, there is nothing. If it bounces here, there's nothing underneath it that needs to be resolved for the stock to move up. It set a new 52-week low, and unfortunately, my one of the rule of thumbs that I work with is when a stock makes a new 52-week high or low, there's a 90% chance it will go 10% higher or lower. So this is not good. But very encouraged by the candle today, especially with the market being down so much. I have this, we just need to close above the high and start basing again. But unfortunately, I think that if the market continues, well, I think the market, both EOSE and NFX, will rally strongly if the market rallies. But I don't see, unless either one of them release meaningful news, the stocks are going to continue to drift down. It's more of a buyer strike because who wants to buy it? Traders aren't going to buy it if there's no operational update or material information coming out, and they're going to wait for that until they make their commitment. So looking at Beyond, I really wanted to short Beyond, and I even had a trade set up, beautiful trade, because of this break level at 445, but I wasn't able to get in today because it moved too quickly. So I will look to reshort this if we can have a rebound in the overall market, and this could then I'll look to short against this high end here. From a overall market standpoint, if we look at the S&P 500 and we pull it out on a weekly basis, okay, I made the comment that we had previously been in a buy the dip mode, right? Every dip was being bought. Well, now we are in a sell the rip mode. Now, if you think that the market has learned its lesson, right, that, oh, we're in a sell the rip mode, I'm telling you right now, there are going to be plenty of people buying these dips, and it's going to keep happening. And the difference this time is going to be, what will happen is you're going to get, you hear in bear markets, you get face ripping rallies. Well, there's going to be a face ripping rally, and people are going to buy that. And it's going to go up for a day or two, and then it's going to immediately reverse and head back down because that's the regime we're in. We are in a downtrend. Okay. And until that ends, I will remain in a sell the rip mode. Overall, look, I'm not worried. I'm not concerned, not even in the least amount. Why? Because I'm looking at the facts. The facts are we don't know what the full effect of the tariffs are going to be. Also, we've already had two of the major countries, Vietnam, one of them, but we had Vietnam come out. I'm trying to find the list here. I don't have it, but let's use Vietnam. Vietnam already is bending the knee. They stated today they want to get down to zero tariffs. I think also Thailand said that. I think they want to go to 5% from 35% tariffs. The big dog right now is China, and I don't want to sound like an obnoxious American, but they're screwed if they don't. They will, and the part of the problem is culturally is they don't want to appear as though they've lost the deal. They don't want to lose face, especially not for their domestic audience. They are really, I read a lot about Asia, and Chinese nationalism. It's incredible. If you think Trump people are incredible, you should, government-run nationalism like they do in China. Yeah, it's incredible. So the Chinese government is in a precarious place now. They're going to lose, they're about to lose their access to the largest consumer market in the world. They cannot replace that. Okay. It's not like they can decide, well, we're going to use a different supplier of buyers. No, they can't. We can. We can find different supply chains as a country. We don't have to buy things from China. Yes, will it hurt us? Absolutely. Will it be painful? Absolutely. However, it will not put this country under. China, yeah, it would. I mean, you've got to understand that their ability to sell product throughout the world, and especially to the US, fuels all of their political and domestic programs as well as their international policy. Their Belt and Road Initiative, what they were trying to create into Europe, primarily had to do with supply chain and energy. That falls apart, okay? If their primary engine of their economy, their primary customer, decides not to do business with them. So the tariffs right now are a big game of chicken. And as far as I'm concerned, 99% of the countries are going to bend the knee. They're going to come back and there's going to be a deal. So I actually was very happy to see the market close at the lows today because for the first time, what did we have? Capitulation. One of my members threw up in the room this chart that had to do with the long short ratio, and I think we just hit a record low on the long short ratio. So there's your capitulation. We got the volume capitulation day, we got the VIX capitulation, and then finally we got obviously the price capitulation. So we closed at the lows. So let me repeat, the tariff situation is fluid. I fully expect over the weekend there to be announcements of deals or anything positive to help support the market through the weekend because Trump doesn't want to wake up to a limit down on Monday. And I don't think we're there yet. like I said, when I hear of something failing, a private equity or a hedge fund or a bank, that's when I start to get more concerned and more serious about real possible lasting down move. Do I think if we get a bounce that it will be all to new all-time highs? Not this one. I don't think so. I don't have enough data in terms of tariffs, interest rates. It's just not there yet. So I'm not making light of the fact that the market was down just because I didn't experience the losses. I took a little bit of loss today on some of my positions. I also added to my SDS inverse trade, and then I added the EOSE leaps this week too. I bought January 2027 $4 leaps, 4% allocation. I think I'm up close to 7% in my portfolio exposure to EOSE. I remain long in leaps with ENVX, very small amount, only 2%. If EOSE breaks above the 450-ish area, my plan is right now I'll add another 4% there, and then we'll see what happens up above the 5 level. So I think we're going to get a bounce. Please do not lose your mind. And for those of you that are listening to this, I appreciate you taking the time. If you've got friends or family that are worried this weekend about their 401ks, feel free to send them this and I'll speak to them directly. Now is not the time to be making any decisions because you don't have a full data set yet. Understand that the news and the mainstream media are not there to help you. They're there to have eyeballs, and the way you get that is to have the most interesting and most outrageous views. And so, all of a sudden we have the mainstream media clamoring that, the U.S. is headed to a recession and they want to blame it on Trump. And look, you got to step away from that and look at the facts. If I, and I'm retired, so I don't have one anymore, if I had a 401k, well, I'll tell you, I have members who do have 401ks, and because of their involvement and with me and talking about risk, um, a lot of them have been in cash for the last 2 months in their 401ks. And so they're thrilled today. They weren't so thrilled when it was going up, but the market was going up, but they did it to protect capital and risk. So is today the day? Should you be jumping ship and running to bonds? No. Should you be jumping in and saying, I think this is the bottom, it's gone down far enough? No, I wouldn't. I mean, again, I'm not giving you specific advice, but I wouldn't be doing that. I'm waiting for data. Let's wait and see. The market is going to tell us directionally when it is safe to go back in the water for a short period of time. Now is not the time. We need to wait and see how this plays out. So I will close that with I don't want to sound like a dick, but it's too late anyway. You should have been thinking about this months ago, right? Risk was high. There, geopolitical risk, the election risk, uh, interest rate risk, recessionary risks. All these risks were there, and from a retirement account standpoint, retirement account, I'd have been getting cash months ago, and many of my members did. Remember, the goal for me is about protecting capital first, following my rules second, because that's what's going to help me give me the best shot in my experience at consistently making money that outperforms the market. So for those of you who don't want to listen, I'm going to do a short commentary right now on that EOS short call. Um, and first of all, I want to give credit to the two young men that are doing it. I thought they were very nice young men, professional. I thought their thesis that they had was reasonable. I think it is wrong because what I found that they did not account for Cerebras involvement at all, from a management side, from the connection side, from the capitalization side. Some of the comments I wrote down there as I was watching their 30-plus minute video, all their points and really one of the big arguments they have was this was a SPAC, and therefore all SPACs are bad. So I can tell you that since they're starting their company, I'm pretty sure what they did is they went through a list of SPACs, right? And that's what they're probably going to continue to do. So these are the comments. They don't take into effect any of the possible and existing positive effects of Cerebras involvement in the company. Okay. and that's from 6 months ago. They had it on one slide in terms of I think it was a loan repayment and capital coming due from them, but other than that, no mention. And that's not intellectually fair. I think if you're gonna present a case, and you're going to present a case from a technology standpoint, which, look, I'm not a technology guy, so I was reading comments about, asked some of my members that are in the sector and understood it. And in terms of they were right on the technology, but they mismatched the use of the technology and assumed that there was no use for the shorter time frame cycle batteries. So I'm not going to accuse them of cherry picking. I'm going to more accuse them of naivety and ignorance. Perhaps they chose to do it that way. If they did, they're going to have a very short history, even doing short reports. So the good thing that I can see, unless they are back money, they're just noise at this point. The criticisms, as I said, are primarily based on what happened pre-June of 2024. They dredged up, they really were critical of the SPAC projections, that EOSE did not meet any of the SPAC revenue projections. And I get, as I sit there, I wanted to take a listen to this. I wanted to start looking at. I had access originally to their original pitch deck, and if you had looked at those projections, right? How about, oh, I don't know, Jeff Bezos, his projections? Oh, that's right, his was a book selling company. So again, I saw complete inflexibility in their opinion that they failed and they refused to acknowledge, and I don't think it was purposeful. I don't know them. But I didn't get that tone out of them. I thought they presented it very professionally, but they are allowing their bias to ignore very important data points. Okay, one of them is that business models do not change and flex. Okay, to some degree, to what's going on with the operating company, the operating history and development of the company, as well as big time data events like June of 2024. Okay, they completely ignored they didn't even give it any credence whatsoever, possibly that could add any positive. Um, when they talk about missing SPAC, and they spent about 10 minutes on it. When they talk about, well, they missed, look at the SPAC projections. Guys, that's called cherry picking. Okay. I can do that all day long with any company. And I can tell you that a lot of companies at development stage they do not hit their estimates until they are running into a full revenue cycle, which EOSE is not. I can't speak to the backlog issue. I've read a number of posters online that are much smarter than I am, and speaking to it as a non-issue. Look, for me, I go back to that price is the purest example, or is the best representation of the expectation of the market. It encompasses all available public and non-public information out there. And so, the fact that um, they're commenting on old projections, that they're stuck on the fact there was a SPAC, that they had no allowance for any involvement from June 2024 on, and they made no comment about that it's made in America. They made no comment that the Assistant Director of Defense is the founder of the investment banking firm behind EOSE. No comment whatsoever. They made no comment. They were talking about supply chain issues, and yet if they take the time to look at the supply chain issues, it was understandable. I commented on this in the fall. People came down on EOSE, and the supply chain issue, and when you looked at it, the understanding was, well, they decided to stick with the supplier that stuck with them. And I said I give Joe a lot of credit for that. I think that's a stand-up thing to do. Did it hurt their business? I don't think so. And why? It's interesting because they pointed out the problem, right? That EOSE had said the revenue's lower because of supply chain issues, and then their comments and they said they fixed it. Okay, so I guess there's no upside effect to that. I mean, if you're going to extrapolate a downside effect on a data point, how about when that data point reverses, you don't give it any allowance or any credit for that? Again, One thing that you got to realize with these types of firms, and this would go for long side firms, they're typically biased like this, and that's why people don't like them, because people know that they're not getting the whole picture, the whole story about it. Ultimately, what I took from the call was their call would have been very relevant prior to June 2024. But as I've said before, um, June 24 changed the story, and it changed the probability of EOS success dramatically. Now, could EOSE be lying about their backlog? I would say, let's take all the issues that they presented. I would say that there's probably a much better probability that the ladies and gentlemen that work for Cerebras, sorry, X Times, um, I would say that there's a much higher probability that the due diligence that they did before they invested $400 million or whatever it was is probably a lot higher than the due diligence that these fine young men did. So, I actually wanted to leave a note for them on Twitter and say, hey, good job, guys, in terms of good effort, well presented. But let me give you some criticism. Uh, you are so enormously biased that uh, you lost any credibility with me because you were intellectually dishonest. You did not present both sides. If both sides of the ledger, and they had done that, and it's what I do this constantly with companies I'm invested in. At the end of the day, to use a Jay Powell comment, at the end of the day, the sum of the data, right? And the sum of the data, what they did is they said, we'll take the data we like, even though a lot of it's old, okay? We will not account for a major inflection point in the company's history, June 2024, and we arrive at this result. I think that's completely intellectually dishonest of those young men. And I doubt they'll listen to this, but if they're listening, you need to do better. Okay. If you want to survive in this industry and you want to stand out, then people know when you are trying to game them. And as I listened to that, uh, well, this reminded me of every other short report, except they were less, emotional about it. I am bullish EOSE. I'm not bullish EOSE because of the story. I'm looking at the data points that have been recently coming out over the last 7 and 8 months. Okay. Is it a guaranteed success? Hell no. No. Could there, if the economy goes into recession, would it affect EOSE? Probably would. Okay. I don't know how much I have concern in terms of municipality uptake of their technology, because if we get lower tax revenues because people are making less money, it might make, municipalities be forced to pull back on their capital expenditure programs. But EOC solution though is a solution that over time pays for itself. So it's not like it's a net income draw or a net operating income revenue draw for a municipality. Ultimately, I give the young men a for effort, and I give them a F for intellectual honesty. I give them a D for analysis, because they either chose or failed to acknowledge perhaps the single most important data point in EOS's history, which was June 2024 last year. They completely failed to even give any weight to that company's involvement. And finally, I don't care who the expert is. I don't give a crap if it's Kramer. As long I know this industry, and I know private equity and hedge funds, and I know the type of due diligence that I used to do, okay, working in an investment banking firm when we did deals, and what they did would probably count as a substandard client presentation. So again, not an attack on them, just on the quality of work, because they put themselves out there. I found nothing in their and as I approach these things, I'm always a little bit anxious, because maybe there will be facts, because I have an open mind, but I found nothing in their report that made me concerned whatsoever. And I think they really missed a chance to establish themselves, um, as being fair and balanced. So I won't spend any time reading any more of their trash, because it was trash. So That's it. Looking over the weekend, what should you do? Breathe, enjoy your family, go to church, whatever it is you do. I really, and I will say this, I want to encourage you, if you're listening and you're not a member of the Discord, come into the Discord, okay? We got CEOs, hedge fund traders, bond traders, interest rate traders. We got COOs, owners of banks. We have people that have never traded before, want to learn how to trade. And we're all there in a community where we respect one another. We have a lot of fun and we're able to bounce ideas off each other. And I think one of the things, if I might close with this, in this environment now, and this is all times, but especially now, you need to have somebody to bounce ideas off of. Now, I'm not saying, me, but somebody that is reasonable before you make investment decisions in this type of environment. Okay. You need somebody, almost what I would call an adult in the room, that can hold your hand and say, it's okay, calm down, don't straight line extrapolate this. I plan on doing hopefully a podcast with Mr. Greg Reyes next week, and he's going to explain in detail his evaluation and screening method that he used both for deciding which company he was going to be the CEO of, as well as for the companies that he's invests in. And as a non-macro guy, a technical guy, he's explained it to me many times, and there is a certain amount of beauty in it. If that will come out next week, I'll also have a podcast coming out earlier in the week. Actually, Greg Reyes will be at the end of the week, earlier in the week, with one of my members who is sits on the other side of the political divide, and we'll be discussing the tariffs and everything. So.
They ain't got no muscle, no hustle, no backbone. I stand alone, not tripping, just saying I'm different. Ain't hanging on to the coattails of the next man. Passport in my left hand, thinking that you are next. Heck, hope you ain't holding your breath, man, cause I'm out here, I'm hungry. I don't play around, trust me. Ain't had as much drive since my Honda Civic got rusty, and my girl said she loved me. It's funny, just thinking back, study hard for that 9 to 5 like I thought it actually be good, but that it was dreaming, still dreaming.